Let's start. Very good afternoon to all the participants and very warm welcome to our webinar. First of all, some ground rules. Guys, all the participants, if you have any questions, please put them in the Q&A section. And if you have any technical queries in terms of connection or any other technical issues, then please put them in the chat bar. And participate as much as you like. We will be picking up the questions as we go along. And there is also a Q&A section at the end of the session where we'll be answering as many questions as we can. So finally, the wait is over and the law has already been announced back on 9th of December 2022. UAE has always been a tax haven, but this has changed now. UAE has all of the taxes, for example, VAT, excise tax, and corporate tax now. Tax landscape is changing worldwide, and it is not about just the compliance, but it is also, more importantly, about the reputation and financial damages to the businesses. We have put together a team of experts who are going to talk about different key aspects of the law to help you understand it better. Rashid and I will be talking about the key provision in the tax law. Suhail will be talking about transfer pricing, and Khushbu will be covering the accounting aspect or implications of the law for you. Before we deep dive into the details, one of the key aspects of the law is general anti-abuse rules, which are already in effect as we speak now. This means that any restructuring for the sole purpose of avoiding the tax will not be accepted by the tax authority. As tax consultants, we have always advised our clients that any restructuring which they need to carry out, it needs to have a commercial and a business rationale apart from the tax reasons. This is very much in line with the global provisions. We are going to cover this in a bit more detail later on during the session. A broader summary of the law, it is very much in line with the public consultation document, which was released back in April 2022. One key change from the public consultation document is that there will be no impact on free zone entities receiving payments from the mainland entities. This is a very welcoming move from the government, and this has also been given as comments by a lot of consultants back to FTA. However, free zone entities will need to comply with transfer pricing rules and some other conditions. Transfer pricing is also fundamental to the tax law. Generally, businesses in the UAE tend to have many businesses as part of the group. And a lot of the businesses are doing multiple activities. So when it comes to implementing and assessing the impact of the corporate tax, it is very important for businesses to comply with the transfer pricing rules, regardless of them being in a mainland or in a free zone. The law has provided provisions also for carrying forward losses, which will be covered in detail later on in the session, as well as provided some provisions around the tax grouping. The only thing to mention here that all of these rules are very much consistent with the global standards, and UAE has taken a huge step in applying and making sure the law is in line with the international standards. Sorry, next slide. Okay. It is already widely known that the corporate tax will be implemented from financial year commencing 1st of June 2023. For example, December year ends will have an effective date of 1st of January 2024. Since the first announcement of introduction of corporate tax, the timelines have significantly reduced from 18 months to 6 months. So businesses will have to act immediately in order to comply with the new regulation. The Pillar 2 timelines are not yet agreed, but these are expected to be effective from 1st of January 2024. So for multinational corporations, any top-up tax or any tax under the Pillar 2 regime will have to be considered at a later date. And they need to keep an eye on any advancements or any new publications which are issued by the OECD and locally by the tax authority here. So further details, once they are issued, then they will have to go back and make sure that all of these new guidelines are adhered to and they are complying with the new regulations. When you talk about the taxable persons, so broadly, these are split into two categories. One is resident persons, and the second one is non-resident persons. There have been no significant changes made compared to the consultation document, which was previously published in relation to these definitions. A resident person includes a legal person incorporated in the UAE, including a free zone entity. These will be subject to worldwide income, with some exceptions in relation to foreign branch profits or dividends. A foreign legal person effectively managed and controlled in the UAE will also be subject to worldwide income tax. This is very much in line with global practices. There is a risk that the foreign entities will be subject to corporate tax if strategic decision and management of these entities are carried out from the UAE. The third category of the residents is a natural person who conducts a business or business activity in the UAE. However, what constitutes a business or business activity will be determined in the cabinet decision. And at the same time, employees who are earning salaries or any other income from working as an employee, they will not be subject to corporate tax. In relation to non-residents, so those have also been categorized into three groups. So the first one is persons who have permanent establishments in the UAE. The permanent establishment rules are very much in line with the definitions which have been given in the tax treaties. For example, if the businesses have offices, permanent establishments, employees, etc., then those will be considered as PE and they will be subject to corporate tax in the UAE. The second one is derived state source income, which can be wide in scope. And the third one is having an access in the UAE. Although, what does that mean, having an access in the UAE? It's also not defined in the law, and it is expected to be explained in the cabinet decision. In summary, for non-residents, any income derived through a UAE permanent establishment or an access in the UAE will be subject to corporate tax. As for any tax law, There are always certain exemptions given to some persons. This is very much in line with the public consultation document, which was previously released. On the left hand of my slide, those are the list of entities which are going to be automatically exempted, which includes government entities, government controlled entities, and charities. The important point to note, excuse me, is that if they are conducted any business or business activities, then there will be a requirement for them to produce a separate set of financial statements and will also have to comply with the transfer pricing rules. On the other hand, the extractive and non-extractive business, which are predominantly your oil and gas sector, these businesses involved in upstream, midstream, or downstream businesses are also exempted, given they are already subject to emirate level taxation. In addition, there are also some other entities which are essentially owned by these exempt persons. They are also being exempted from being taxed. However, there is one condition they have to comply with, that they need to make sure that they apply for an exemption from the FTA. Without having an approval from FTA, they will not be eligible for any exemption. And the effective date of the exemption will be applicable from the first applicable tax period. This is also very important topic, as there are so many entities who are currently operating from the free zones. A lot of questions have already been asked by many of our clients and many other people, and they are curious about what's going to happen for the free zone entities and whether they will be subject to tax or not. Unfortunately, the law has given some details around this area. However, some details are yet to be announced as part of the cabinet decision. As part of the public consultation document, which was released previously, it was mentioned that any income which is derived from outside of UAE and from the other free zone, that will be subject to 0% tax. And anything which is derived from the mainland or inside UAE, then that will be subject to 9% corporate tax. It is yet to see that whether free zone entities can segregate these two separate types of incomes in the same entity, or they will have to do that through having a main branch in the mainland. It is one of the conditions for the free zone entities to maintain adequate substance in the UAE for them to qualify for the exemption or 0% taxation. It is also important for businesses operating from free zones to make sure that there is enough substance maintained and transfer pricing rules are complied with. As an important aspect which has already mentioned in the law is the general anti-abuse rules. Those will also be applicable to the free zone entities. So businesses which are operating from the free zones, they also have to make sure that they comply with the guard rules as well. Now I'm going to hand over to my colleague Rashid, who is going to talk you through some aspects on the tax return, what that's going to look like, and also what are the key provisions related to calculation of the corporate tax. Over to you, Rashid.
Good afternoon, everyone. Thank you very much for joining us today for the corporate tax webinar. So I'll be talking about the corporate tax rates applicable. So as previously outlined by Arslan, individuals and juridical persons will be within the scope of UAE corporate tax law. So as per the law, 0% taxable income will be subject from 375,000. That will be subject to 0% tax, and amount beyond 375,000 will be subject to 9% corporate tax. How this will be calculated will be, there will be certain adjustments which will be clarifying in coming slides. On the other hand, for qualifying free zone persons, if the income is qualifying income and which will be meeting certain conditions, then 0% corporate tax rate will be applicable. On the other hand, if it is non-qualifying income, the standard 9% will be applicable. Next slide. So CT calculation is fairly simple. UAE has taken a very simple approach on this when we compare with some mature jurisdiction worldwide. So the first amount will be the net profit as per the financial statement. Then there will be certain calculations or adjustments which include unrealized gains and losses. Then there will be deduction of exempt income, reliefs, and certain non-deductible expense. So this is very interesting to note that UAE has taken a very clear position on deductible expenses. So first will be the exempt income. Then there will be a limitation on interest expense. Then we have interest expense on the loans obtained from related parties, entertainment expense, and other expenses which will not be allowed. For example, fines and penalties, input VAT, donations paid to unapproved organizations, bribes, etc. Then we might have some certain TP adjustment if applicable, and a deduction of tax losses will be allowed, and then we come up to the final income tax amount. Now there will be a calculation here. 375,000 will be applied 0%, and beyond that will be at a 9%. Finally, in order to calculate the final CT payable or refund position, if there is any foreign tax credit on withholding tax, that will be deducted, and the taxpayer will be in a position to determine what is the final corporate tax amount, whether it is payable or refundable position with the Federal Tax Authority. We go on to the next slide, please. Now, in this slide, I'll explain certain capping rules. As I have previously outlined, interest will be not allowed to a certain extent. So law has clearly outlined that it will be a limitation of 30% earnings before interest, tax, depreciation, and amortization amount, which is again in line with BEPS Action Plan number 4 of OECD. Then the key point they have highlighted is if this interest is related to an related party transaction, it should be on arm's length principle as well as must have a valid commercial reason. Second thing is certain payments are totally disallowed 100%. This includes donations to unauthorized charities, grants, gifts, fine, penalties, bribes. Then VAT, particularly input VAT, will be disallowed. For the entertainment expense, it is very interesting to note there is a restriction up to 50% of the amount spent. Now, this will include what would constitute an entertainment expense. They have outlined it would be meals, accommodations, admission fees, and certain other expenses. So this will be limited to 50%. On the other hand, UAE VAT regime is 100% blocking these expenses. So this is a very interesting move from the UAE tax authorities that they have allowed 50% for the corporate tax purposes. On to the next slide. So similar to VAT, corporate tax groups will be allowed, and it will be restricted to legal persons, and there will be what I mean is qualifying free zone persons and exempt persons will not be allowed to be a part of corporate tax groups. So one of the conditions is there should be 95% shareholding of the parent company, of the share capital, voting rights, and whether it should be directly or indirectly through one or more subsidiaries. Interestingly, a very good accounting point to consider, the parent company and the subsidiary company must have same financial year end, and they must be using same accounting standard and policies. The conditions to form a corporate tax also includes application. So tax groups will not be automatically formed. The taxpayer must submit a formal application with the supporting documentation to form a corporate tax group. So what will be the impact of corporate tax group? The first impact will be there will be one corporate tax return to be filed by the parent company. So the results of the financial asset liabilities, etc., of the tax group will be consolidated. Additionally, there will be intercompany transactions eliminations, and there will be certain provisions for pre-group tax losses and conditions for ceasing a tax group or joining a new member or leaving a new member. So tax group periods will be specified in the application. So what it means is if any group of companies is forming a tax group for corporate tax purposes, they have to specify from which tax period this group will start. When a member of a tax group will leave a tax group, it will be the same date, in fact backdated, which is specified at the time of the application. Now I'll hand over it to my colleague, Mr. Suhail Memon, who will be taking you through the key aspect of transfer pricing. Over to you, Suhail.
Yes, very good afternoon to everyone. Thank you, Rashid, and thank you, Arslan sir, for such a wonderful presentation. Let's move on to a very important topic, which is called transfer pricing. Firstly, let's understand in a simple manner what is transfer pricing and why transfer pricing. Usually, what businesses used to do is they tend to book their profits in a jurisdiction where there is a zero tax or a less tax compared to a jurisdiction in where they are earning that amount. So what they used to do is they used to charge or book more profits in their jurisdiction where they have a less taxes. So in order to avoid this, transfer pricing rules came into play. Now, transfer pricing rules in UAE are also as per OECD guidelines. Transfer pricing rules are introduced to ensure that transactions between related parties and connected persons are carried out at arm's length principle. Now, arm's length principle, you can say, for an example, that if you are dealing with related parties, the price of the goods or services should be in terms with what you are providing it to a third party. Transfer pricing rules are applicable in cross-border transactions as well as domestic transactions. Now, the important aspect comes is of related parties and connected persons, which are mentioned over here. You can see on the right-hand side of my slide. It's important for business to identify who are the related parties and connected persons, and it needs to be ensured that transactions done with them are done at arm's length principle. To determine arm's length principle, there are methods specified. You can see the methods on the left-hand side of my screen. There are the methods mentioned. The welcoming move by this corporate tax law is they have allowed other methods. What would it mean, other methods? It would help businesses to identify the transactions according to their business practices. Well, it is dependent on many things. For an example, contractual terms, characteristics of a transaction, economic substances, functions performed, etc. I would request for the next slide, please. Well, as you can see, the major aspect of transfer pricing is documentation. As you can see the point over here, disclosure. Now, what is disclosure? Disclosure forms is a list of the related party transactions which need to be submitted in transfer pricing documentation. Here comes two aspects, local file as well as master file. Master file is very much in line with OECD guidelines, and some of you might already be preparing master files in other tax jurisdictions. Well, local file, you can say, is your first line of defense or first set of documentations which help businesses in proving that particular transactions with related parties are in accordance with arm's length principle. As you can see, the threshold for transfer pricing rules applicability are not yet declared, but it would be declared in near future. Small businesses would be out of the net of transfer pricing. There is a very famous case in India related to Vodafone India Limited, which was related to transfer pricing as well as capital gains. Well, what I'm trying to say here is that businesses in UAE need to identify the proper related party transactions, do proper documentations. They have to ensure that the transactions are done at arm's length principle. Otherwise, the adjusted taxable income would increase if you have not followed the rules and you end up paying more in the taxes. So basic gist of it is it that transfer pricing documentations need to be done properly by following the proper methods and proving that the method which we have followed is correct. So now we move forward and I request Mrs. Khushbu to take our session further with transitional rules.
Thank you very much, Sohail. It was a very well explained transfer pricing topic. Arslan, can you please move to the next slide? Thank you. So today I'm talking about transitional rules of the federal decree law. What are the transitional rules? Whenever there's a new law introduced, certain rules are put forward to guide and smoothen the conversion process. Over here in the corporate tax, the emphasis regarding the accounting is mostly based on opening balances. What is the opening balance? Definitely is the closing balance from the previous year. As you can see on the slide, that the first reporting period for the companies who have a December year end will be 31st December 2024. It means that the opening balance sheet will be as of 1st January 2024. For that purpose, the closing balance sheet of 31st December 2023 needs to be prepared in a way that is acceptable by the corporate tax. So what are the specific methods or the ways that they have prescribed in the transitional rules? The first one is it needs to be in accordance with the accounting standards that are applicable in the UAE, preferably the IFRS. Then they are specifying that it should be on the arm's length principle, means your balance sheet, your balances as of 31st December 2023 year end should be as per the arm's length principle. And also you should make sure that the financial statements are also considering into account the transfer pricing rules and regulations as prescribed by my fellow colleague Sohail in the previous slides. So these are the three main areas that we need to consider. It should be as per IFRS or any specified accounting standard in the UAE. It should be on arm's length principle, and as well as it should be on transfer pricing rules. Then you should note that on day one, which is 1st January 2024, there will be no temporary differences. What is a temporary difference? The difference between the carrying value of accounting and the carrying value as per tax law, which we call as tax base. So the difference between the accounting carrying value and the tax base will be zero as of 1st January 2024. Why? Because we have not implemented the tax regulations as of the opening date. But when we come to the year end, the reporting period, which will be 31st December 2024, the accounting carrying value will be as per the required guidelines of IFRS or any other accounting standard, whereas the tax base, the balance sheet as per the tax laws might be different from the IFRS or the accounting requirements due to different treatments that may be allowed or disallowed in accounting and the tax. So here comes the temporary differences. And these temporary differences will give rise to deferred taxation. It can be either a liability or an asset as of the year end. For deferred taxation, there is a separate standard in IFRS, and we will cover it in our next session, hopefully soon. Then there is one more requirement of the transitional rules, which is all the transactions and the arrangements that will be entered into after the date of effectiveness, which is 10th October 2020, which has already been done, 2022, sorry. So all the arrangements or transactions will be subject to General Anti-Abuse Rules, which is the GAR, which Arslan sir just explained. So the purpose of this GAR is there should not be any undue advantage of the corporate tax, like any avoidance or the reduction of taxes, creation or increasing the tax refunds, deferral of any corporate tax, or any avoidance of the tax compliances. These are the four main areas which can lead to the corporate tax advantage for which GAR is implemented. The rules of GAR suggest that all the transactions should have a substance over form. The important point over here is to note that when the authorities will consider your transactions as well as arrangements through GAR, there is a possibility that some transactions or arrangement might be disregarded for the purpose of tax calculation. For instance, if there is any company that suddenly moves its operation from the mainland to free zone, or they change its financial year, the timing and the intention can be questioned by the tax authorities. Or if there is any owner who have started withdrawing its salary from the company, which was not done previously, and they started doing it after the effective date, which is 10th October 2022. Again, this new arrangement can also be questioned. So to summarize, the transaction rules are already effective. As I told you that the date of effectiveness is 10th October 2022. So we are already in the transactional period. We all need to make sure that we abide by the rules and the regulation of the transition that are being suggested by the official gazette. I would like to request Arslan to take it forward from here. Thank you so much.
Thank you, Khushbu. So, guys, it is very exciting time, and the history is being made in UAE. I'm sure all of the businesses and the tax consultants, we all going to be very busy in the foreseeable future, making sure we understand what is happening in the tax landscape, what updates we are receiving, and also how we are going to adopt the new law and make sure we are compliant. So far from a journey perspective, where we are now is we already have the law, and businesses now will have to act on it immediately. If you remember, when the VAT law was also being implemented, there were businesses who were taking proactive approach, and they already started working on it months in advance. So similarly here, so there are businesses who are already working with us, who have already taken the first phase of the planning and the impact analysis already. And now it's a matter of them moving on to the next phase. But at the same time, there are a lot of other businesses who probably have not done anything so far, and they were waiting for the law to come out. The timelines to act on it are very critical, and businesses have very less time left to make sure they comply with the law. When the introduction of the corporate tax happened, businesses had 18 months, and now is down to barely 5 to 6 months. So it is imperative for people to make sure that they start analyzing their internal structure, businesses. So businesses will have to assess what is the effective rate of tax which they are going to pay in future. Their future profits are going to be reduced by 9% going forward. And you need to assess whether there are any legitimate ways for you to actually reduce your tax burden going forward. So businesses will need to assess their operations from a free zone versus mainland perspective, and some of which may require some restructuring. In addition, the transfer pricing rules are fundamental to everything in the tax law which has been published, because it is applicable to not only entities who are locally operating, as well as operating in the free zones. So TP rules needs to be something which need to be worked on. People need to go and identify all the related party transactions, analyze what method they are going to use to come up with the transfer pricing applicable for those. And in all of this, the anti-abuse rules will also play a very important part in the consideration, because businesses will need to make sure that any restructuring or any such changes they are making, which is not currently in place, then it will be questionable by the tax authorities. We have a three-phase approach, which deals with the significant change. So in the first phase, we help businesses planning and analyzing the impact in light of the law. And then in the second phase, we help the businesses implementing the whatever has been analyzed in the phase one, and then also provide an ongoing support. So there are a lot of people who have already done the quantitative and qualitative analysis with us to figure out what structural changes they have to do, what is the changes they need to consider from a legal perspective, what are the changes they need to consider from an operational perspective, how they need to make sure that they will review their intergroup balances, transactions, financing arrangements, and all the other aspects of the business, like do they have the right people, do they have the right processes and technology, etc. So how their system will interact with these compliance requirements and reporting. And this is the time is of essence here, and businesses need to act now. The law is here and it's a very much reality. So if you need any help, then please get in touch with our expert team. So we already have been asked so many questions. So now we're going to go through these some of these questions as long as the time permits. And please, guys, you still have the opportunity to post any more questions if you have, because we have already gone through what we wanted to cover. But just in case, if anybody still don't get a chance to post any questions or need to ask a question later date, we have our email ID on this slide. So please feel free to get in touch and we will do our best to get back to you. So there are already a lot of questions which have been asked by the participants, and thank you so much for your participation. So I'm going to go through some of these. So one person is asking, is it a must to submit an audited financial to the FTA? So right now, the short answer is no. The FTA or the regulation doesn't really make it mandatory for the audited financial statements to be submitted along with the returns. However, when the cabinet decision comes, then there may be other implications, and they might ask the audited financial statements to be submitted. And apologies, I'm not going to go in any particular order because I'm just going to go through as I see on my screen because it keeps moving. So the Next question is it possible for a single owner to form a tax group for CT in order to make it a single taxable person? And are there benefits of doing that? So like Rashid has already explained. Rashid, do you mind answering this question, please?
Yeah, my question, it's a little bit unclear because the question is single owner. So is it a national person or a corporate? So if it is the corporate, then yes, it will be allowed. But again, if it's a single person, we need to look into what are the other aspects. So I'm happy to take these questions offline and resolve it. So I'll post my email. So whichever question is lacking clarity, we can happily answer them offline. So I'll just post my email. They can send me an email on this.
So the next question is, the company is based in DMCC and they are trading in agri-commodities, sourcing the commodities from outside UAE and selling it outside UAE. Although it doesn't really say what is the question here, but I'm assuming you wanted to know whether you will qualify for 0% tax or not. So like I think previously we have already talked about that the free zone entities, they subject to certain conditions. They will be subject to 0% corporate tax as on their qualifying income, although we don't really know as yet what is the definition of qualifying income. But the expectation is that free zone entities who are dealing with overseas entities or in the other free zones, subject to the other conditions, then they will not be subject to any corporate tax.
Just to add on this commodities business, they have just outlined one source of income, which is like buying from one country and selling to other country. So from VAT perspective, this could be out of scope, but from corporate tax perspective, the P is in the UAE, so it will be a taxable income. But again, the question is, it's a DMCC free zone, so will it qualify as a free zone or not? So that again is to be seen. But again, I assume if they are into derivative accounting, they might need to look into their other balances as well. This could be the stock and the year-end valuations of the derivatives. So the simple answer is we have to wait for the cabinet decision where they will clarify other conditions, and then the company will be in a better position to assess what next steps they can take forward. Over to the next question, Aslan.
Next question is, can you please confirm if we qualify as qualifying free zone? I think it's the same person who's asking that, the same question. So right now the list of qualifying free zones is not yet published. So that is something which is most likely to come in the cabinet decision. Then somebody is talking about the tax group slide, but I'm not sure what the question is. So whoever is asking that question, can you please clarify what you want to know about the tax group?
I'll just answer that the point the gentleman anonymous attendee is asking. So it's related to entertainment expense. So what is interesting is from VAT perspective, entertainment expense is completely blocked, but from corporate tax perspective, it is 50% allowed. So here the business need to mind that when you're calculating the 50%, will you take the input VAT or you will not take the VAT, input VAT in that? So this is an interesting point. Over to the next question.
So next question is talking about foreign tax credits. That's, I think, also Rashid for you. Do we have double tax avoidance treaties in place with the countries, or is it something not required?
Yes, there are more than 90 plus double tax treaties effective with the UAE, So again, it depends on which specific country you're talking about. And yes, foreign tax credits will be allowed. Withholding tax exempt credits are available. But again, that depends on which country and which type of transaction you're doing. Usually withholding tax is applied on services. So we need to specifically look on which transactions the gentleman is asking. So email is given, they can provide more detail on the transaction. We are happy to answer that question.
Next question is also Rashid for you. For foreign tax credits, what if the foreign tax credit is more than the actual tax liability?
Here it will be restricted. It will not exceed, it will be restricted amount. So it cannot go, for example, before applying the foreign tax credit, there is a profit of 50,000 and the actual tax liability on the other side of the border is 70,000. Tax credit will be restricted to 50. It will not go beyond that.
Okay. The next question is somebody saying that they are operating from Sharjah airport free zone. They are selling 95% overseas and 5% in the UAE market. And then how the corporate tax going to affect them, and what are the responsible for 9% tax on the total income or the income earned from the UAE alone? So I think it's very similar to the question being asked earlier as well. For the free zones, right now, it is not very clear what is going to constitute as a qualifying income. The public consultation document did talk about that any overseas income you are earning, that will be subject to 0% tax, but the law is silent on it. So we are not able to confirm 100% what's going to happen, but the expectation is that the overseas income earned in a free zone, subject to some other conditions, you will be subject to 0% taxation. But the cabinet decision will clarify such questions. Have UAE issued transfer pricing rule? So that's the question for you, Suhail.
Yes, I would like to answer this question. Yes, we have gone through the articles I mentioned in my presentation as well, that transfer pricing rules are applicable. The only thing is that the threshold limit is yet to be mentioned for the domestic as well as cross-border transactions. Otherwise, as per OECD guidelines, UAE has also followed the transfer pricing rules as mentioned in Chapter 10.
Okay, thank you. Next question is how UAE residents earning income worldwide is taxable? So I think that's a question for you, Rashid.
Yes, it's pretty clear. It will be worldwide income is taxable. If a UAE resident company or is operating a business worldwide, the taxable income will be worldwide sources. But again, as the gentleman previously asked, double tax treaties, there could be some relief coming from withholding tax relief. But the clear answer is worldwide income is within the scope of corporate tax.
And also just to add, I think people are just getting confused in terms of there is a clear definition given for resident and non-resident persons in the tax law. And also it has been mentioned that who is going to be taxed and why. So in case of a resident person, because they are resident here, and depending on how the foreign entity is being operating and what sort of percentage they own of that foreign entity. However, whatever tax you have paid in the country overseas, that is also something you will get as a double tax relief as well. So it's not that you're going to be double taxed in the UAE as well. Okay, so they're saying company incorporated in June, adopted as a January to December year end. So the first financial year is 7 months. So what will be the first tax period of that business? Okay, So in that case, look, the law is very clear. The effective date of the corporate tax law is any financial year commencing 1st of June 2023. So if you have incorporated the entity in 2022, then your financial year will become taxable. The only thing here it needs to consider, because first year, if you are doing a shorter period of financial statements, then it will be outside the scope, and then your next financial year it will become subject to corporate tax. Okay, next question is somebody asking, we have a JV and then there are a lot of expenses incurred by the group company, and then these are expenses reimbursed at cost. So what are the arm's length basis rules in relation to such reimbursements?
Oh, shall I answer this question, Arslan sir?
Yeah, that's for you, yes.
Actually, we need to get into details of the transactions which is talking about, but what I can understand is that the expenses done with related parties or income with related parties, we need to make sure that the benefit is not passed on. That is, it is done as per you are doing it with third party. So if this gentleman makes his question clear, we can definitely answer him more clearly about this.
Okay. And then also, I think depending on the nature of the transaction, it needs to be assessed as to, based on the nature, like Suhail mentioned during his session, that there are different methods which are available for you to determine what should be the transfer pricing for such transactions. So then based on that nature and other aspects, then you will determine what you have to do in relation to transfer pricing. Next question is asking about tax groups and consolidated accounts. They're saying if the consolidated accounts for a tax group required only for the corporate tax return, or the local accounting gap would also require a consolidated financial statements. That's for you, Rashid. Rashid, you are on mute.
So could you please repeat the question?
So the question is whether preparing a consolidated financial statements, is it going to be the requirement because of you have a tax group, or is that something going to be in the accounting gap requirement?
So tax group is a discretion which the taxpayer has to take the decision. So whatever you are doing as a financial reporting and your group falls under the consolidation rules, that practice you have to continue. But for corporate tax purposes, that will depend on what taxpayer takes a decision. If they take a decision that we want to form a tax group and they're meeting the condition and they're following the procedures outlined, then they will qualify for the tax group. So I believe the reporting, what they have been doing usually, the group reporting purpose, they need to continue it.
And then also just to add on that the consolidated financial statements is a requirement for you to submit the corporate tax return for a group. However, the accounting standard, you will still continue to apply whatever gap you are following. If you are following IFRS, then if IFRS doesn't require you to have a consolidated financial statements, then you may not need to do it, but you might end up doing it for a corporate tax purposes. But generally, the both of them go hand in hand. Okay, then we have the same question. Okay, then next question is asking about how will UAE source income of a non-resident be taxed, especially when there is no withholding taxes? Do the local payer of an amount to a foreigner need to make sure anything before making payment? So right now, honestly, the withholding tax, although there is a provision in the law, but the withholding tax percentage is 0%. So my expectation is that later on in the future, there might be corporate withholding tax also applicable to the foreign entities. But right now it's going to be at 0%. So essentially they will not pay any withholding tax. So they are talking about, next question is treatment of rental income in the personal capacity. So Rashid, you want to take that question?
So here we need to understand in his personal capacity, will it fall under the definition of business activity? So this question is not clear. So, and second thing is it a resident or a non-resident? So it needs to be very clearly outlined, then we will be in a position to answer it.
So next question is for you, Suhail. So they're saying for transfer pricing, if the company have more than one branch, then can they apply different TP methods?
See, basically, law says it that they have given the methods and they have said combination of methods and other methods. Now, why would I feel that company try to choose other methods if the transactions are in line? If you cannot have two methods for same transactions, either it can be a combination or the method which you feel is good. So why would company try to make it more hectic for themselves by applying two methods? That is my point of concern. So if they define the activity clearly and you can say the best method where you can answer that this is at arm's length principle, it would be good. Thank
Okay,
you.
I think we still have a lot of questions which we not going to be able to answer in the interest of time because we are out of time now. However, what we will do is we will go through the questions which have been posted and then we will try to answer via email to you guys. And I think some of you have already asked if we will be sharing the presentation and stuff. So we will share the presentation with the participants in an email anyway. So thank you so much once again for the participation and coming on to our webinar and being so accommodating and participating during the session. So thank you so much. And then that's it from us.
Thank you very much.
Thank you very much for all the participants.
Thank you for your patient listening. Thank you.